$78 trillion. That's the total value of global debt denominated in US dollars right now. Every barrel of oil, every international trade settlement, every central bank reserve, all priced in one currency, the dollar. But on December 12th, 2024, something changed. Saudi Arabia quietly let its 50-year petrodollar agreement expire without renewal. Not a tweet, not a press release, just silence. And in that silence, the largest systemic shift in modern monetary history began. This isn't a prediction, this is a pattern, and it's already playing out exactly as it has 3 times before in recorded history. The reserve currency is dying, and you're watching it happen in real time. Let me be clear about what we're dealing with here. This isn't about politics. This isn't about America versus China. This is about a mechanical, unavoidable, historically verified pattern that has destroyed every dominant currency system for the last 600 years. And right now, we're in stage 3 of a 4-stage collapse that has never, not once, been reversed. The pattern is simple, brutal, undeniable. Stage 1 is establishment. A nation becomes the global economic powerhouse through actual production, innovation, and trade dominance. They earn their currency supremacy. Stage 2 is expansion and debasement. That same nation begins printing its currency to fund wars, welfare, and debt instead of producing real value. The currency spreads globally, but its intrinsic worth quietly erodes. Stage 3 is crisis and loss of control. Other nations notice the debasement. They start seeking alternatives. Trade agreements shift, confidence cracks. The exodus begins slowly and then suddenly. Stage 4 is inevitable collapse. The reserve currency loses its status. Hyperinflation or deflation follows. Economic chaos spreads. A new system emerges, and the cycle starts again. This pattern is played out 3 times in modern history with perfect consistency. Every single time, the dominant power believed they were the exception. Every single time, they were wrong. Let me show you exactly how this works. 15th century. They were the first true global economic superpower. While Europe fought over scraps of land, Portugal was mapping the world. Vasco da Gama rounded Africa and opened direct trade routes to India in 1498. Suddenly, Portuguese ships controlled the spice trade, silk, gold, precious metals flowing directly from Asia to Lisbon. They bypassed the Venetian and Ottoman middlemen entirely. The Portuguese real became the first truly global currency. If you wanted Asian goods, you needed Portuguese reals. That's stage 1, establishment through production and trade dominance. But here's where it gets interesting. Portugal didn't stay disciplined. King Manuel I and his successors got drunk on easy money. They started diluting their coinage, adding base metals to gold coins, reducing silver content in reals. Why? To fund wars in Morocco, to build palaces, to maintain a massive navy they couldn't actually afford through legitimate tax revenue. Between 1500 and 1580, the silver content in Portuguese coins dropped by nearly 40%. The currency spread everywhere. Portuguese coins circulated in India, Africa, Brazil, even China. But the value was quietly evaporating. That's stage 2, expansion and debasement. Then came stage 3. Other nations noticed. Spanish merchants started refusing Portuguese coins unless they were weighed and assayed for actual metal content. Indian traders demanded payment in pure silver or goods instead of debased currency. By 1580, Portugal's currency credibility was destroyed. And here's the kicker. When Spain annexed Portugal that same year, they immediately stopped using Portuguese monetary instruments in international trade. 70 years of currency dominance, gone, replaced almost overnight by Spanish silver reals, which actually contained the silver they claimed. Stage 4 hit Portugal hard, economic collapse. Loss of trade monopolies. The entire empire hollowed out within a generation. The pattern played out perfectly. Establishment, debasement, loss of confidence, collapse, check, verified, undeniable, Portugal. Now let's jump forward. Britain, 19th century. After defeating Napoleon in 1815, Britain became the undisputed global superpower. The pound sterling was backed by gold. The British Empire produced actual goods, textiles, steel, machinery, coal. They didn't just print money, they earned global currency status through industrial dominance and naval supremacy that protected trade routes. By 1860, over 60% of global trade was denominated in pounds. The gold standard meant you could exchange pounds for actual gold at a fixed rate. Trust was absolute. That's stage 1 again. Establishment through production and real value. But then came stage 2. World War I changed everything. Britain started printing pounds to fund the war effort. They suspended the gold standard in 1914. 4 years of total war cost them 40 billion pounds. That's roughly 10 times their pre-war GDP. They couldn't pay for it through taxation or actual production. So they printed and borrowed and printed more. After the war, they tried returning to the gold standard in 1925, but at an overvalued exchange rate that destroyed British exports. Winston Churchill, as Chancellor of the Exchequer, later called this decision the biggest mistake of his life. The pound was pegged at pre-war levels, even though Britain's productive capacity had been devastated. British goods became too expensive. Exports collapsed. Unemployment soared. Meanwhile, the pound kept circulating globally. London remained the financial center. But the currency was now backed by debt and promises instead of production and gold reserves. Stage 3 arrived during World War II. By 1940, Britain was bankrupt. They couldn't defend the empire, couldn't fund the war, had to beg America for loans and supplies. The Lend-Lease program essentially meant Britain mortgaged the empire to the United States. After the war, the Bretton Woods Agreement in 1944 officially ended pound dominance. The dollar, backed by American gold reserves and industrial might, became the new reserve currency. Britain fought this. Churchill resisted. The Bank of England tried maintaining pound zones with Commonwealth countries. Didn't matter. By 1967, the pound was devalued by 14%. By 1976, Britain had to go to the IMF for a bailout like a developing nation. The Prime Minister had to implement austerity measures dictated by international creditors. Stage 4 complete. A currency that dominated global trade for over a century was reduced to regional status within 30 years. The pattern played out again. Establishment, debasement through war spending, loss of confidence, collapse. Check, verified, undeniable. Third example. Let's go back further. The Dutch guilder, 17th century. After winning independence from Spain, the Netherlands became the richest nation per capita in the world. Why? Actual production and innovation. They built better ships, created joint stock companies like the Dutch East India Company, pioneered modern banking and credit systems. Amsterdam became the financial capital of Europe. The guilder was trusted everywhere because it was backed by real commercial activity and stable precious metal content. Stage 1, earned dominance. Then Stage 2 hit. The Dutch got complacent, they stopped innovating, started living off financial engineering instead of production. They inflated massive speculative bubbles like tulip mania in 1637. More importantly, they started debasing their currency to fund wars against France and England. The Second Anglo-Dutch War cost them dearly. They printed money backed by future tax revenues that never materialized. The guilder kept circulating in global trade, but the value was eroding. Dutch financial instruments became increasingly complex and disconnected from real assets. Sound familiar? Stage 3 came when England and France both surpassed Dutch naval power by the early 1700s. Trade routes shifted. The guilder lost its monopoly status in Baltic and Asian trade. By 1780, during the Fourth Anglo-Dutch War, the Netherlands was effectively bankrupt. They couldn't compete militarily or economically. The guilder collapsed as a reserve currency. Stage 4 was complete by 1800 when Napoleon conquered the Netherlands and imposed the French franc. The entire Dutch Golden Age ended. A currency system that dominated for over a century was replaced within a generation. Same pattern: establishment, debasement, loss of confidence, collapse, check, verified, undeniable. Now here's what matters. These aren't random events. This is a pattern, a system. A mechanical process that operates regardless of technology, culture, or human intention. Every dominant currency in history has followed this exact 4-stage progression. And right now, the US dollar is deep into Stage 3. Let me prove it to you with current events that are happening right now as we speak. Stage 1 for the dollar was establishment through production. After World War II, America produced over 50% of global manufacturing output. Real goods, cars, steel, electronics, machinery. The dollar was backed by gold at $35 per ounce, and America held 70% of the world's gold reserves. When other countries needed to rebuild, they needed dollars to buy American products. The dollar earned its reserve status. That was 1944 to roughly 1971. Establishment through actual value. Check. Stage 2 began in 1971 when Nixon closed the gold window. America couldn't maintain gold backing anymore because they'd printed too many dollars, funding the Vietnam War and Great Society programs. Suddenly, the dollar was backed by nothing except the promise of the US government. But here's the brilliant part. America made a deal with Saudi Arabia. In 1974, Henry Kissinger negotiated an agreement. Saudi Arabia would only sell oil in dollars. In exchange, America would provide military protection and buy Saudi debt. This was the petrodollar system. Instant global dollar demand. Every country needs energy. Every country needs oil. Therefore, every country needs dollars. Genius. Except it wasn't backed by production anymore. It was backed by military force and a political agreement. Classic Stage 2. The currency spreads through coercion and debt instead of earned value. And America started printing. Reagan deficits, Bush war spending, Obama stimulus, Trump tax cuts, Biden pandemic response. The money supply has increased by over 800% since 1971. 800%. But GDP has only increased by about 500%. That gap is pure debasement. The dollar circulates everywhere. It's still the global reserve, but the value is quietly evaporating, just like Portuguese reals, British pounds, and Dutch guilders before it. Stage 2. Check. Now we're in stage 3. Crisis and loss of control. And this is where Saudi Arabia comes in. December 12th, 2024, the petrodollar agreement expired. 50 years of guaranteed dollar dominance in oil markets just ended. Saudi Arabia didn't renew it. Why? Because they're already making other deals with China. Since 2023, Saudi Arabia has been accepting yuan for oil sales to Chinese companies. Small amounts at first, testing the system. But the precedent is set. Brazil and Argentina are now settling trade in yuan instead of dollars. The UAE is building yuan clearinghouses. Russia is selling oil to India in rupees and yuan, completely bypassing dollars. Even France sold liquefied natural gas to China denominated in yuan in 2023. These aren't predictions. These are done deals. Verified transactions. The exodus has begun, and it's accelerating. Look at central bank behavior. According to the IMF, global central bank dollar reserves have dropped from 71% in 1999 to under 59% in 2024. That's a 12% decline. Sounds small until you realize that represents trillions of dollars being converted to other assets. China has been buying gold at record rates. Their official reserves are over 2,200 tons now, but analysts believe the real number is closer to 4,000 tons because they're buying through proxies. Russia dumped nearly all its dollar reserves after 2014 sanctions. They bought gold, yuan, and euros instead. Even allied nations are diversifying. Germany repatriated much of its gold from New York. The Netherlands did the same. Why? Because confidence is cracking. And when Turkey, India, and Saudi Arabia all announce gold buying programs in the same year, that's not coincidence. That's stage 3. Loss of control. The exodus begins slowly, then suddenly, check, verified, undeniable. But here's where it gets really interesting. China isn't just accepting yuan for oil, they're building an entire alternative system. The Cross-Border Interbank Payment System, CIPS, is China's answer to SWIFT. It processes yuan transactions between countries without touching the dollar system at all. It launched in 2015 with 19 banks. By 2024, over 1,400 financial institutions in more than 100 countries are connected to CIPS. The Belt and Road Initiative has loaned out over $1 trillion to build infrastructure across Asia, Africa, and Latin America. Those loans are denominated in yuan. Those projects require yuan for construction and maintenance. China is creating yuan demand the same way America created dollar demand. Through infrastructure, trade, and political agreements, the system is being rebuilt in real time with China at the center instead of America. And Saudi Arabia is the linchpin. They're the swing vote. For 50 years, Saudi Arabia guaranteed that oil meant dollars. Their decision to let that agreement expire is the single most important monetary event since Nixon closed the gold window in 1971. Think about what this means. Saudi Arabia is the world's second largest oil exporter. They produce about 11 million barrels per day. At $80 per barrel, that's $880 million per day, over $300 billion per year. If even 20% of that shifts to yuan, that's $60 billion of yuan demand created annually. Multiply that across OPEC nations, across other commodity exporters, across international trade settlements. The numbers become staggering. We're talking about trillions of dollars that no longer need to be held in dollar reserves. And where does that displaced dollar demand go? Back to America as inflation. Because if foreigners don't need to hold dollars for trade, they sell those dollars. Dollars flowing back home while production hasn't increased means prices rise. Inflation, loss of purchasing power, stage 3 accelerating towards stage 4. Now let's talk about what the skeptics say, because there are 3 common arguments against this analysis, and all 3 are wrong. First argument, the dollar is too big to fail. The network effects are too strong. Everyone uses dollars. The system is locked in. Wrong. That's exactly what they said about the guilder, about the pound. The pound sterling was used in over 60% of global trade in 1914. By 1950, it was under 20%. Network effects collapse faster than anyone expects when confidence breaks. Once the shift starts, it accelerates because of game theory. The first countries to diversify away from a dying currency get the best exchange rates. The last countries stuck holding devalued reserves get crushed. So there's a rush to the exits. We're already seeing this with central bank gold purchases hitting 50-year highs. That's not random. That's game theory in action. Second argument, America has the strongest military. They can force dollar usage. Wrong again. Military power didn't save the British pound when the empire collapsed. It didn't save the Portuguese real when Spain took over. Military dominance and currency dominance are correlated but not permanently linked. America is currently running a defense budget of over $850 billion per year. That's more than the next 10 countries combined. But they're funding it with debt and printed money, not production and surpluses. That's the definition of stage 2 debasement. The military protects the currency until the cost of that military destroys the currency. We're at that tipping point now. How do you project force in the Middle East when Saudi Arabia doesn't need your protection anymore? When they're making defense deals with China instead? When UAE is buying Chinese weapon systems? The military argument falls apart when the economics collapse underneath it. Third argument. China's economy is too fragile to support a reserve currency. The yuan isn't fully convertible. Their debt levels are unsustainable. True, but incomplete. China doesn't need to be perfect. They just need to be better than a declining America. And right now, they're running a manufacturing surplus. They produce real goods, electric vehicles, solar panels, electronics, machinery, the same way America did in 1945, the same way Britain did in 1815. Meanwhile, America runs a trade deficit of almost $1 trillion per year. We import more than we export. We consume more than we produce. That's the signature of stage 2 debasement. China is offering countries an alternative backed by production. America is offering an alternative backed by debt and military threats. Which one wins long term? History is very clear on this question. And here's something most people miss. The transition doesn't require the yuan to become the next global reserve currency. It just requires the dollar to lose its monopoly status. We could be heading toward a multipolar currency world. Yuan for Asia, euro for Europe, gold for central banks, digital currencies for tech transactions. The point is that dollar dominance ends. That's what triggers stage 4. Not necessarily yuan dominance, just dollar loss of control. And that loss of control is happening right now in dozens of small ways that add up to a massive structural shift. So where does this leave us? Stage 3 is playing out right now. The Saudi decision not to renew the petrodollar agreement is the inflection point. It's the moment historians will look back on and say, that is when it became irreversible. Because once Saudi Arabia opens the door to yuan oil pricing, other OPEC nations follow. UAE already has yuan clearinghouses. Iraq is discussing oil sales to China and yuan. Kuwait, Oman, Qatar, they all follow the Saudi lead. That's another 3 million barrels per day, 5 million, 10 million. At some point, the dollar isn't the primary oil currency anymore. It's just one option among several. And once that happens, the cascade accelerates. Other commodities follow: copper, lithium, rare earths, then manufactured goods, then services. The dollar doesn't collapse overnight. It erodes, slowly at first, then very, very quickly. Let me give you the timeline we're probably looking at based on historical patterns. Stage 3 typically lasts between 10 to 30 years, from the first major cracks to complete loss of reserve status. The pound started cracking in 1914 and was finished by 1950. 36 years. The guilder started failing around 1780 and was gone by 1815. 35 years. For the dollar, the first real crack was probably the 2008 financial crisis, when global trust in American financial management shattered. That's 16 years ago. We're in the middle of stage 3 right now. If the pattern holds, we have somewhere between 5 to 15 years before stage 4 hits in full force, before the dollar loses reserve status completely, before inflation or deflation spirals out of control, before the system breaks and a new order emerges. And here's what makes this different from previous transitions. This isn't happening in isolation. The world is more connected now, more leveraged, more complex. When the pound collapsed, it affected the British Empire and its trading partners. But the global economy was fragmented. Countries could still isolate themselves. Today, everything is interconnected. Derivatives markets, digital finance, algorithmic trading, global supply chains. When the dollar loses reserve status, the shockwaves will hit everywhere simultaneously. There's no safe corner to hide in, no isolated economy that can sit this out. The leverage in the system is unprecedented. According to the Bank for International Settlements, global derivatives exposure is over $600 trillion. That's 7 times global GDP, all of it denominated primarily in dollars. When the dollar destabilizes, all of that leveraged exposure implodes. Banks fail, pension funds collapse, insurance companies go bankrupt. This won't be a gentle transition. It will be violent, chaotic, and devastating for anyone unprepared. But here's the critical insight. This isn't about fear. This is about pattern recognition. Once you see the pattern, you can position yourself accordingly. Let's talk about what you actually do with this information. First, understand that diversification means real assets, not paper assets. Gold, silver, productive land, commodities. These are stores of value that exist outside the currency system. When currencies collapse, they collapse into hard assets. The Weimar Republic printed marks until they were worthless. But an ounce of gold still bought the same amount of bread. The same will be true during the dollar's decline. If you're holding only dollars or dollar-denominated assets like bonds or savings accounts, you're holding the losing hand. Convert some of that into assets that hold value across currency regimes. Physical gold, not paper gold, not ETFs, actual metal you can hold. Because when the system breaks, counterparty risk becomes everything. Paper promises fail, physical assets endure. Second, pay attention to commodity-producing nations and currencies. Australia, Canada, Chile, Brazil. Countries that export real goods will fare better than countries that export debt and dollars. The Australian dollar, Norwegian krone, Canadian dollar. These currencies are backed by actual resources. As global trade reorients away from financialization and back toward production, resource-backed currencies gain relative strength. This doesn't mean they won't suffer. Everything will suffer during a reserve currency transition. But relative performance matters. If the dollar loses 60% of its value and commodity currencies only lose 30%, that's a massive difference in outcome. Third, reduce dollar-denominated debt where possible. Because here's what happens during currency collapse. If you owe dollars and dollars hyperinflate, that debt becomes easier to pay back, but your purchasing power evaporates. If you owe dollars and dollars deflate through credit contraction, that debt becomes impossible to service and you default. Either way, carrying large amounts of debt during a currency crisis is dangerous. You're exposed to outcomes you can't control. Reduce that exposure. Build buffers. Create optionality. The people who survive currency crises are the ones with flexibility. The people who get crushed are the ones locked into rigid financial structures they can't escape. Fourth, understand that this benefits certain actors enormously. China, obviously, Russia. Any nation that has been preparing for dollar decline. They've been accumulating gold, building alternative payment systems, creating yuan and rupee trade agreements. They saw this coming and positioned accordingly. BRICS expansion isn't random. Brazil, Russia, India, China, South Africa, plus Saudi Arabia, UAE, Egypt, Ethiopia, Iran. These countries represent over 40% of global GDP now. They're building a trade bloc that doesn't need dollars. That's the new system emerging, while the old system dies. Watch what they do, not what Western media says about what they do. Follow the actual trade deals. Follow the currency agreements. Follow the infrastructure investments. That's where the future is being built. Fifth, recognize that technology doesn't change the pattern. Cryptocurrency advocates will say Bitcoin fixes this. Maybe. But Bitcoin doesn't have a military, doesn't have oil backing, doesn't have the institutional adoption needed to replace the dollar yet. It might play a role in the next system. It might not. The pattern shows that new reserve currencies emerge from nations with production, resources, and trade surpluses, not from decentralized protocols, at least not historically. Could this time be different? Possibly. But betting your entire financial future on a historically unprecedented outcome is speculation, not strategy. Hedge your bets. Own some crypto if you believe in it. But don't put everything into an unproven system during the most volatile monetary transition in living memory. Sixth, prepare for political instability. Every currency collapse in history triggered political upheaval. The Weimar hyperinflation led to the rise of Nazi Germany. The pound's collapse ended the British Empire and triggered global wars. The guilders' failure coincided with French Revolutionary Wars. When currencies fail, governments fail. Social contracts break, populations revolt. America is already politically divided. Imagine that division during 40% inflation or 30% unemployment depression. Civil unrest, political extremism, potential balkanization. These aren't predictions. These are historical patterns following currency collapse. Hope for the best, but prepare for instability. Have backup plans. Have community networks. Have resources outside the formal system. Seventh, understand the asymmetry. If you prepare for this pattern and it doesn't happen, you own hard assets that still have value. You've diversified across currencies and geographies. You've reduced debt and built optionality. You're fine. Maybe you underperformed by a few percent compared to someone who went all in on dollar-denominated stocks. So what? But if you don't prepare and this pattern does happen, you're completely exposed. Your retirement in dollar-based assets evaporates. Your savings lose purchasing power. Your job disappears as the economy contracts. Total devastation. The risk-reward asymmetry is obvious. Preparing costs little and protects much. Not preparing saves little and risks everything. And here's the most important part that most people will ignore until it's too late. The window for preparation is closing. It is not closed yet, but it is narrowing fast. Right now, you still have options. You can still buy gold at prices that make sense. You can still diversify into foreign assets before restrictions tighten. You can still reduce debt while interest rates, although high, are at least predictable. You can still position yourself calmly, rationally, and deliberately before fear takes over the system. But once stage 4 begins in earnest, those options vanish almost overnight. Gold doesn't just rise in price, it disappears. What remains becomes prohibitively expensive or tightly controlled. Governments impose capital controls, blocking the free movement of money. Credit markets seize up as lenders retreat, and liquidity dries up. Access, not opportunity, becomes the real currency. By the time the majority finally understands what's happening, action is no longer possible. That is the nature of exponential change. It feels slow, almost boring, for years. Then suddenly, it's everywhere, all at once. We are still in that slow, deceptive phase. But the Saudi decision to let the petrodollar agreement expire is the warning signal. The acceleration has begun. The pattern is clear. Establishment through production, expansion through debasement, crisis and loss of control, inevitable collapse, Portugal, Netherlands, Britain. All followed this exact path. The dollar is following it now. Stage 3 is active. Saudi Arabia's decision not to renew the petrodollar agreement is the confirmation signal. The alternatives are being built by China and BRICS nations right now. The timeline is probably 5 to 15 years before full stage 4 collapse. The outcomes are predictable based on historical precedent. Inflation or deflation spirals, political instability, economic chaos, then emergence of a new system centered on production and resources instead of debt and printed money. This isn't pessimism. This isn't conspiracy theory. This is pattern recognition based on 600 years of monetary history. The question isn't whether this happens. The question is whether you position yourself to survive it or get crushed by it. The skeptics will say this time is different. American exceptionalism. Technology changes everything. The dollar is too big to fail. They're wrong. They're always wrong. Every dominant power in history believed they were the exception. None were. The pattern is mechanical. The pattern is ruthless. The pattern is currently playing out exactly as it has 3 times before. And you're watching it happen in real time. The only question left is what you do about it. The answer will determine whether you emerge from this transition stronger or broken. Choose carefully. The clock is already running. And unlike previous transitions, this one is happening in a globally interconnected, highly leveraged system where mistakes compound instantly and second chances don't exist. The stakes have never been higher, the pattern has never been clearer, and the time to act is right now, before the gradual becomes sudden and preparation becomes impossible.